In this video, I'm going to introduce the best fair value gap indicator on TradingView, and then I will teach you how you can effectively trade based on this. So make sure you watch this video until the end and let's get started. Alright, first let me explain what a fair value gap is. A fair value gap forms when we have 3 consecutive candles where there is a gap between the shadows of the first and third candle. This gap is left by market imbalance, and this is usually considered where the institutional traders were active and created imbalances in the supply and demand. A fair value gap can be used for confirmation of breakouts, and it can also act as a magnet for the future price action, which means it can act as a potential support or resistance level, and this can help us to find very accurate trading entries. There are indicators on TradingView that can help you to identify fair value gaps on the chart, and in this video I'm going to introduce one of the best of them ever created on TradingView platform. I will teach you how you can effectively trade fair value gaps, so make sure you watch this video until the end. To add the indicator to our chart, here we click on indicators and we search multi-time frame fair value gap, this one, which is an editor specs indicator and written by Zierman. Alright, this is the indicator, and as you can see it is overlaid on the price chart and identified the fair value gap that we had here. This indicator is a multi-time frame fair value gap, which means that regardless of your chart time frame, you can choose any time frame that you want to find fair value gaps. And the excellent feature of this indicator is that it gives you volume information for the identified fair value gap, and it shows it separately for buying volume and selling volume. As you can see, we have a green bar and a red bar. Green bar shows buying volume and red bar shows selling volume. This is a bullish fair value gap, and for a bullish fair value gap, we want considerably higher buying volume. In this case, you can see that we have considerably more buying volume, and this shows that this fair value gap is strong. The higher the amount of the buying volume, the stronger is the bullish fair value gap. Similarly, in a bearish fair value gap, we want considerably more selling volume. Alright, we have also a line here, which is actually a trend line, and it is calculated based on a low pass Butterworth filter, and this will help us to know if the identified fair value gap is in the direction of the trend or against the trend. In this case, the identified fair value gap is bullish and it is in the direction of the trend. This will help us to focus on setups that are in the direction of the current trend, so we can better take our trading decisions and take higher probability positions. Alright, now let me teach you how you can use fair value gaps to enter a trade. Here you can see that we have a resistance level. The price reached to this point and then went down. Again here, hardly rejected and went down. This is a rejection candle showing rejection of the higher prices. So here we have a resistance level, and when the price reaches to this level, it is expected that the price will go down, or maybe the price could break this level and go up. Based on price action trading concepts, if the price breaks this level and a candle closed above this level with confirmation of volume, which means with increase of volume, we can say that we had a breakout, so we can enter a long position. For better explanation, let me add volume to our chart, this one, so I can completely show what happened here. Here you can see that we got a candle closed above this level, I mean this resistance level, and for this candle the volume is also increased. So based on price action trading concepts in practice, we could enter a long position at this point and catch this sharp movement of the price. By the way, if you're interested to learn price action trading, recently I published a book, The Art of Price Action Trading. The link is in the description, and you can get it later if you're interested to learn price action analysis and take your trading to the next level. Alright, so here we have a confirmed breakout setup, but in the middle of this breakout setup, we have also another formation, which is a fair value gap, and this shows a rapid increase of the price, creating imbalance between supply and demand, and you can see how the price advanced after that. As I mentioned earlier, fair value gap can act as a potential support or resistance level for the future price action. In this case, because this is a bullish fair value gap, it will act as a support level. Sometimes right after the formation of fair value gap, we have a pullback which can fill the gap and go down or jump back in the direction of the fair value gap. In other cases, it may take longer time for the price price to reach to the fair value gap. As I mentioned earlier, fair value gap acts as a magnet for the future price action because this is the area of imbalance for supply and demand, and it can act as a support or resistance level. In this case, it will act as a support level. On this chart, you can clearly see that we had decline and stopping of the price exactly at this level where we had a fair value gap. This is not random or by chance. This is the area where we had imbalance between supply and demand, and exactly where we had a break out of this resistance level. This price range is a strong support level, and you can see that 2 times the price tried to break this level and go down, but it couldn't. This is a double bottom pattern. Following this decline of the price couldn't make lower low, and a double bottom pattern formed on the chart. Based on price action trading concepts, we mark the high of the pattern, and when this level is broken and we get a candle closed above this level, we can enter a long position. For this candle that is closed above this level, you can see that the volume is weak, and this is because the previous candle was very strong, engulfing how many candles before that, and closing exactly at the level with very high amount of volume. This is exactly where the shift for buying pressure happened, so it is normal to have lower volume for the next candle. And the excellent point about this setup is that we have also formation of fair value gap here, a bullish fair value gap with considerably higher buying volume. So here again, like our first example, we have confluence of 2 signals, and this tells us that we have a very high probability that the price is gonna advance more. In practice, we could enter a long position at this point, and you can see how the price advanced after that. This is how different concepts are mixed together to find high probability setups in the market. Please pay attention that I said high probability, not guaranteed setups. You can never have 100% guaranteed signals. This is not possible in reality, and losing positions are always part of the game. Even if you have the most perfect setup with many signals confirming it, the market condition can suddenly change. So you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it's one of the best risk management strategies that you can use. By the help of this risk management strategy, you can limit your losing positions to a minimum amount, so you can effectively protect your trading account from falling significantly. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it because without a proper risk management strategy, you cannot become a consistently profitable trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.